So what's up, guys? How are you doing? Uh, it's actually been a while since I've dropped any video breakdowns, right? So, and it's actually because I've been losing a lot of interest in dropping my chat works online and all. Because at the end of the day, there's a lot of free content out there, and you don't have any reason not to be profitable. But regardless, I decided to do this one, so I'll just explain some little things that would help you in a very very big way. Like I used to say, it's all simple stuff. If you like complicate trading for yourself, if you like speak grammars, you are the one that know all those kind of stuff. But at the end of the day, it still goes back to liquidity, price, time, money. That's just it. Get stopped out, market move away from you. Get stopped out, market move away. So those are just the simple principles. Actually, I'm having a sleepless night again. No, not like sleepless night. I slept very early. I slept around, I think, 7 p.m. And that's not actually my usual thing. So I woke up not quite long. I woke up around 2:30. So I just felt like, let me come on this board and show you guys one or two things. At the end of this video, you guys will be able to understand basic money transfer, basic inducement, because I'm not really going to be going too deep. But trust me, when I say I'm not going to go too deep, just believe that I'm going to go very deep. But I'm not going to go very deep. So let's get to it. I want to give you guys a breakdown of this move that I caught. This one here. And hopefully this one here. And this one right here. This trade. So I will give you guys breakdowns on them. Maybe, maybe not, but I will give you guys for this one and this one. So let's get to it. Looking at this chart, when it comes to money transfer, I want you guys to understand one thing. When they say transferring of money, the basic understanding of that is when market move, let's say market is moving in an uptrend, and when a uptrend is going consecutively, that means we have a break of structure here. Market transfer money from this point to this point, and it respectfully accepted the transfer. That is why it's able to make a new high, transfer from here to this one, right? And then again, it goes again, transfer money to this guy, but it is until it showed the success of the transfer by creating a new high, that is when you can say it is a valid money transfer. So this is just the structural normal understanding of it, but I don't trade like this. I trade inducement and all. So I'll be using these simple basics to explain one or two things for you. And if you understand money transfer and how it works, you'll be able to understand mitigations and how market actually move price from one point to the other. You just have to understand that there's a lot of things going on. This is, at the end of the day, this is it. But it is not this picture perfect, it's not this textbook, it is always much more tricky. But once you understand the fractal nature of transfers and how transfer has been manipulated, you'll be able to get yourself inside any trade. Trust me, you will. Forget about the whole drama that have been happening on Twitter these days, bro. Trust me, at the end of the day, it is simple, and all you need is price actions and some knowledge about liquidity. Not to a pro level, actually. You can just get simple knowledge. Once you make money, that's actually what matters. It is not all about who knows how to do it the best, and it's not all about who make the best. It's all about the kind of life you live in. It's all about the comfortable life you are living. Fuck how much you make. So far you are not begging from anyone, then you are fine. I don't pray to be the richest in the world. Trust me, that's what delusional if I tell you that's what I pray for. But I pray to be comfortable, and I pray to be able to like it, and I buy it. I pray to be able to like something and immediately I'm able to afford it. Okay? So that's my dream, not to outsmart everybody in the world. I don't give a fuck about that. So now let's get to it. Now, using this basic principle, there's something we call complex pullbacks. There's something we call internal structures, right? And what is internal structures? Internal structures is when the market is moving in an uptrend, and let's say this is an uptrend. Now let's say money has been transferred from this guy to this guy, and then all of a sudden we have another one. I'm going to be very, very basics. Then after having that other one, you now have like stuff like this before they broke the structure. So all this right here, money transfer from year to year, transfer from year to year, successfully received, it broke structure. So everything here, it's what we call the internal structures. And internal structures are always being calculated after a break of structure has been made. The first pullback to it, if it did not get cleared, which is this pullback right here, everything above it is just what is an internal structures. So which means all this, when look, using this as an example now, you can see that we had this trap zone, whatsoever you want to call it, this flag, and then the market induced it. After taking it out, we have a clear break of structure. So all this break of structure now, you can see market did what? Give us an internal structure right here. So internal structures, don't get caught up in trying to trade from it. You can see that this is the first break of structure in this range. After having this break of structure, market pull back, then this guy become an inducement. So you can see it happens after a break of structure. So that break of structure is what I call an incomplete pullback, because if you measure from here to here, what kind of fib is this? Oh, how am I going to measure this thing? Okay, let me use that fib like that. I've not made the settings, that's why. From here to that, you can see that our 50% level is this green line right here, and the market didn't pull back to it. You can see this green line right here, that is our 50% level. You can see 0.5, right? So market didn't pull back to it. This makes this incomplete pullback, so it needs to be cleared. So after being cleared, what do you notice on the norms here? There's a lot of activities that might have gone on here that, trust me, I will have capitalized on it. But for this video's sake, I'm not really going to go too deep. Like looking at this trade, we had this trap. You can see that trap right there. Then the market actually induced the low, break structure, right? Then what? Mitigate. That's an entry for me. Another break of structure, inducement, mitigate. We move to the upside, then we have this trap, inducement, SMC liquidity, or whatever you call it, true break of structure, inducement, entry, lower time frame confirmation. We have a trap right here, break of structure, entry. Simple stuff, but that is not the purpose of this video. But I just showed you guys the breakdown right now. So now we have the internal range, liquidity. So market came back to clear it. Then the same bigger picture of this, the smaller picture happens here. So after having that smaller picture, we got an inducement at some point here. Then the market came to mitigate. So after the mitigation, what does that imply? That implies that market transfer money after this inducement right here, transfer money from here to here. So after the transfer of money, what happened next? You can see, like I said, once a break of structure has been made, that means it has successfully received the transfer. Then you have a break of structure right here. After having that break of structure, what is the next thing you should be having at the back of your mind? You should see that when a point successfully accepts a money transfer, that simply means that point is a valid swing point for the next potential move. Then looking at this trade, after analyzing this, we have this protected eye, which actually takes out this liquidity with broke structure. So which means market transfer money from here to here. It received it, it transferred from here again to here. It received it, you can see, from here to this low. It received it from there, then it transfer another one to this guy right here. But you can see, the only way I said they received it is they broke structure. They broke structure. This one too broke structure. But now that it is now here, as at this point, did they break structure? No. So which means it is not successfully received. So which means that failure of receive of that money transfer, which actually makes this market move to the upside, that simply tell you that there's a violation in price, there's a violation in order flow, there's a violation in money transfer. So that violation point is now your what? Is now your point of interest. So you can see we have a break of structure here with the same concept of internal range liquidity that I explained here. You can see we have the same thing here. So how do I know that is an internal range liquidity? The same concept again, from this low to this high that caused the first pullback. This is our 50% retracement. It did not get there. That simply tell you that what? That this guy is an inducement. So if this guy is an inducement, what happened next? Are we going to be looking for my trade here? No, I am not, because fine, there's a rule that said the closest POI to liquidity is the point I will trade. But based on this price action, you can see that this is the point that the market ignores the money transfer because it refused to create a new low right here. So creating that new low, you can tell that this guy is now a violation point because it violated the rules of order flow or whatever you want to call it. So now that means this guy a point of interest. Trust me, I got this trade directly even without a lower time frame confirmation because I know what I'm looking for and I know where to look for it, but I'm not going to show you guys that. Even breaking down this, I've already said a lot. Yes, I've said a lot because the concept of this range liquidity, I don't know how your mentor has actually explained it to you, but this is it. It's not as hard as you think. But trust me, if I tell you something, I am very, very flexible in this market. So I know what to do and how to do it over and over again. So this point is a range liquidity. You, as a beginner, I would advise you not to trade it. But me, I will trade it because I know what to do. And that's why I broke it down for you here. The same thing here. I know exactly what to do to get in on trades. So if you have not up to that level, just stay calm and wait for big expansions. So now this is my POI right here. Because we've transferred money after locking liquidity here, transfer money to here, then we're expecting a new high. So what did I do? After market getting to my POI, which is as at this point, what am I anticipating? I'm anticipating because this guy has already received the transfer from here. So I'm expecting this guy to transfer to this, and I'm expecting it to what? Successfully receive it by creating a new high. So what am I going to do? After market getting to my POI, let me use the replay tool. The funny thing is my student will probably be angry for the fact that I dropped this video for you guys. But I'm sorry guys, it's been a while I showed them stuff, so they shouldn't really vex for us. Let them just take this little out of things. I'm really sorry guys, actually there's a lot of free content everywhere, but I don't really like to give too much. Okay, so my student, I'm really sorry. Let's just give them a little. Okay, the thing is they won't really take it seriously, but they don't know how important it is. So now let's go to 1 minute. And what do you expect? We have different types of liquidity. Once market gather our liquidity, this is just one of it out of other ones that I've actually taught my mentee. Once market take out your liquidity, you're expecting what? The ABC rule: market break structure, pullback, come back, boom. Then this is one of it. The market come here and buy. This is just one of it. Or market come here, high, low, high, low, high. The market break two structures. There's a reason why it needs to break two structures. This is not just breaking two structures. There has to be a rule that will happen somewhere around here. But I'm not going to tell you what the rule is. You can make your own research before I can validate the buy. So the market get to this point. Let me play the price. So playing the price, I have this thing should move faster. We don't have all day. Boom. So now looking at this price, what do we have? You can see based on the same thing that I explained the other time. Based on the other thing that I explained, you can see we had money transfer right here, money transfer right here, but this guy failed to create a new low, which means this guy did not receive the money transfer to the bearish side, so it broke structure, right? So breaking this structure, it makes this guy a POI for me. So making that guy a POI, you can see I would buy from here, put my stop loss right beneath this guy. That's like 6 pips stop loss. Then what will I do? I'll be targeting my all-time highs. But am I just going to just enter the trade and leave it to get to the all-time highs to actually complete the transfer that has been existing? Nah, I'm not going to do that. So that's where my trade zone rule comes in. I'm going to analyze the market opposite against my buyers. So saying I want to analyze against my buyers, you can see we have this trap. After this trap, we induce it, we transfer money, inducement, right to here, major inducement. There's a why this happened. So that major inducement we broke structure. So transfer money from here to this guy, broke two structures, they still violated it. So which means, like I said, internal structures from this high to this low. Is it up to 50% pullback? No, internal structures. So which means this point is going to be a trade zone for me in the future. This is just the basics. But me as a person, my trade zone is actually here. If you check the chart, this is where I choose, and there's a reason why I choose it. But no, to your own understanding, to what I just explained in a simple way, this is it. So which means anytime I can get to this point, I would rather do two things: take partials and edge. Right? I can take partials and let it run, or I will not take partials, I will just edge, which means once it gets here, I will sell. I will sell to some point with a bigger lot size than even the buy, right? So I'll get to a certain point, I'll close the wholesale, then I'll let my buy run, because I know it's just a short time trade. It's a threat, because order flow transfer to this inducement, it needs to have its own transfer too. So having said that, I would let's play the price. Price keep doing whatever it wants to do. Then move quick, bro. Then we gotten on the buy successfully. Then the market start moving aggressively to the upside. You can see that after moving, go to our trade zone, you have a very, very sharp. This point is not even where the market will reverse from, but like I said, this is the trade zone for basic. This is the internal liquidity for basic understanding, but this is mine right here. I'm not going to explain why, because that means I'll be going too far. Right? This is not just back testing. You will see it on the chart. So now playing the price, you can see it triggered my stuff. So as at that point, I edged from here. So once I edge from here like that, then my market will get to a point, I get to my TP of the sell, I let the buy run. Depends on how I feel about the trade. So the market keep moving, boom, boom, boom. And we continue the buy to the upside. Isn't the basic understanding? I think I said I would break down this guy. So we keep moving until we got to our final TP. So that is that about that for the particular setup. And let me try to see if I can quickly break this down. So this particular trade is still the same thing, but this is very, very more tricky. We took out inducement at this guy. Then we shift character, then we enter from here. That's two basics though, but that's the entry right there. I'm not going to be going too deep. I don't know how to talk less. I know how to talk a lot. So I'll probably just give you guys what I'm not supposed to give you guys. So inducement, change of character, entry, basic. Okay, so now that is that about that. So that is just how this thing goes, and now I'm able to capitalize on it. The funny thing is I actually entered with I think how many lot size? I think I entered with 20 lot size on this particular trade. Yep, I think that's what I did. I entered with 20 lot size. Where's the trade? Yep, I think I entered with 20 lot size. Okay, I can't even click it. I'm trying to show the trade if I have it here. But that's that about that. That's that about that. So thank you guys. I hope you watch the video over and over and over and over again for your own good. It's not by force. I hope you watch it. And I give you guys a question on edging, right? So, and I asked you guys few questions about it, and some of you get it right, some of you did not get it right. So that's why I'm making this video, to explain how you can edge your positions to help you be. There's nothing like the right side of the market, but you can actually be in the best side or play the game on the 50-50 level. So which means no matter where the market is going, you will also be present. It's as simple as that. So, and you can only do that with a proper knowledge of edging. So I'll be explaining the simple logic on how you can edge, and you can just make your own other research, because there's limits to where I can go because of my students, right? So, but edging is something a lot of people don't talk about. Even though I know that after dropping this video, you guys will not really appreciate it that much because you didn't pay for it. But there will be one day somebody will teach you edging, and you have to fall back to this video to watch over and over again. Now, this is the price action we'll be using to explain the whole edging of a thing, right? So now, let me remove this drawing. I won't be using the replay tool. Remember, this is free, and this is not a financial advice. So now looking at this chart, there's something you have to understand when it comes to the market. You have to know your buyers. You have to know where the market is going to. And by knowing where the market is going to, the layman explanation is, where are they printing the big volumes? Looking at this chart, you can actually see that they are printing the big volumes to the sell side. They are printing the big volumes to the sell side. There's not much complication when it comes to structure, but this is one thing you should understand. All the big volumes, they are to the sell side. So which tell you that the algorithm is printing to the downside, which means the big boys prefer the downside to the upside. Not like the market is not going to go to the upside, but you can see how slow it is. So which means the big boys are also following the downtrend, and you want to follow them. So that's why we'll be looking to sell. So looking at this chart right here, you can actually see that we have a high, a low, a high, a low, a high, a low, a high, a high. This didn't break this structure, so we have a high to a low. Then this failed. So now, having all this, we know that all this price action right here, we are in a retracement. Okay, every retracement has a thing they need to do, and like I used to say in a lot of my videos, retracement has two purposes to fill. It's either to come and fill in balance, right, or to just give the price a discount price. It can be a discount, you understand? When the market has overextended, the market has to exhaust. So by the exhaustion of the price, the market needs to retrace, because the market just can't keep going down like this. Never. It can't just keep going down. No, sorry, it just can't keep going straight down like this. There has to be an impulse, there has to be retracement, because there is always a buyer and a seller in the market. And every time the market is selling, expect buyers. And every time the market is buying, expect sellers. It's just that the big volume is going to be to one side, which is the direction the algorithm wish to go to. Okay, so all we can just try to notice is we want to follow the trend, and by following the trend, after understanding your highs and lows, your swing highs and swing lows that you all understood, you should try to notice where the market is printing the big volumes at. Because remember, we retail traders cannot move the market, because there's always a buy and sell in the market, and we retail traders, we might actually just occupy 50% of buy, 50% of sell, which means the market is going to be consolidated. So when you have a big push like this, it's because the algorithm itself is willing to go to the downside. That's why we are having this aggressive move, and you can see how slow this is. This is like a sign of weakness. Okay, so when market is selling, so this is a sign of weakness in the buy, which results to another sell. So having said that, you guys understand structure already, and if you don't understand it, go back to your mentor and ask questions about structure. So let me go back to the main thing that we are supposed to talk about. So now we can see that everything right here is to the downside. So having this to the downside, so what are we supposed to be looking out for? We have a swing guy right here, and and we have our major swing low right here. I'm sure you guys will be wondering, why did I choose this as my swing low? It's because of the fact that we are having a low to a high, a low, right? But we don't have a break construction yet. And for every strong high, there has to be a weak low. This is a strong high, but a weak low has to originate itself after a break construction. We have a high, we have a low. So we don't have nothing yet, not until we have this break construction. After having this break construction, then we can call this what? Our swing low, because this is the origin of this breaks, of this break. So that is a very, very important thing that I just gave out. So you have to go back over and over again to try to understand what I said there. Okay, so we now have our trading range to be from this high to this low, right? So which means, and after that you can now draw your fib, right? I don't want you guys to see my fib settings because there are some key things there. So let me use this from this high to this low. So now you can see that the market has what? Retraced to, as at this point in time, you can see that the price has retraced to above 50%. This is the 50% line here. After the weak low has been created, right here. Okay, the market has retraced above 50%, which is giving me a signal that this is time to sell. Remember, my bias is to sell. As at this point in time, I am looking to sell. So after looking at that fact, I got to my discount price in my desired POI, right? Remember, most of you guys will probably be looking at this guy to sell from. And you can see that the market did not even get there. That's why you still have a lot of things to learn. Market does not really necessarily need to get to your point of interest. Okay? Market does not necessarily need to get to your point of interest. There are some things that needs to happen that would move price, not all about your point of interest. Okay? So now, market get to my discount price. Let me use that lean language. So now we now have a high to a low, a high. Then we have a contraction right here. Then we manipulate it. Then we broke structure. So having all this now, what am I going to do? Remember, I am looking to sell. So now, the fact that I'm looking to sell, I will have caught this sell directly, but I'm not going to break it down. So now let me break it down from the buy perspective. Like I said, in every sell environment, there has to be a buy. So now looking at this, we have this liquidity sitting down right here. Having this liquidity as a result of the fact that these guys are several mitigations. And when you have a several mitigations in the market, they are creation of liquidity. So the market came down to clear the liquidity back to this point of interest, this demand, which is going to give me my perfect buy. And before that guy, there's something that happened that would even give me much more confidence to buy this thing, which is the result of this simple price action that happened here. So the logic is a contraction, expansion. No, contraction, manipulation, and expansion. What does that mean? It means contraction, which is manipulation, which is consolidation. Then you have a manipulation, then you have an expansion. This is the ICT logic. So now, I took my buy from here. Remember, let's say I took this buy with what? With 10 lot size. With 10 lots. At the beginning, I took this buy with 10 lot size. So let me make it big. So I took it with a 10 lot size. After taking it with a 10 lot size, there's something I used to call a trend zone for my student, and those are the points that is going against your buyers. If you are looking to buy, there will always be some price action to the sell side that is telling you I am going to sell. That is your trend zone. And remember, for this particular buyers, we are looking to sell. Now, this guy right here is my break and retest level, so that is my liquidity. So market came back there. Once market get to this guy, I'll be closing 70% of my volume. So which means I'll be having 10 lots minus 7 lots. So after having that, I'll be left with 3 lot size. I'll be left with just 3 lots. So now, as at that point, I am rest assured that okay, I have paid myself. So out of that 3 lots that I've closed, that I have left, I will know that this sell that I'm trying to take now, even if it stopped me out I am fine because this buy will still be running, and remember I have already closed some profit out. So now after that, market got to my sell. So based on you people's QM that you trade, even though that is not what I saw, so you have your QM right here, and you take your sell right here. This is not my trading style, right? I don't use 11 pip stop loss actually. So you have your QM, whatever you call it, you take your sell from there. After taking that sell from here, now let's say you open this again with a 10 lot size. Another 10 lot. Remember, your new lot has to be bigger than your previous lot. This started with 10 lot, and I closed 7 lots. I have taken out a lot of partials. Now, for this guy, I opened a 10 lot size, which is bigger than the 3 lot that is left, which means if this sell keep going down and stop this 3 lot out, I'm still going to be in the major move of the price because I have paid myself from the buy position that I took. So now, taking this sell, I will still have to identify that, okay, I took this sell, but it still doesn't change the fact that we are still in where? In this bullish order flow right here. So knowing that fact, I know that I still have to be careful in trying to hold this sell to overall target. So which means I will still have to analyze the price action to the bullish side. Now, I could spot a liquidity again right there and have an order block right here. Remember, this is the point of the manipulation, and that is where you want to pick your other blocks from. So now, based on you guys trading style, I'll have to take a buy right here. So before taking that buy, once market get to this guy, what will I do again? I will minus 7 lot. That is subjective. It might depend on whatever that you feel comfortable with. Which I will be left with another 3 lot. So now, after getting to this guy, I am left with what? 3 lot size. Again, so I have 3 lots on this buy, 3 lots on this sell. And remember, I have paid myself from the buy. I have also paid myself from the sell. Okay? So now, the fact that I've done both. Hello, ma. Yes, ma. The castle, ma. Kò sí wàhálà, ma. Ọláyọ̀ ṣọ́yìn. Kò sí wàhálà. Tẹ́ bá ti délé kẹ́ pè mí, ma. Okay, ma. So now, I have 7 lots left. I have 3 lots left. So 3 lots on the buy, 3 lots on the sell. But remember, I have closed 7 lots from the 2 positions. So I've paid myself. In this type of situation, let me ask you a question. How would you feel? You will feel so extremely relaxed because any outcome of the market has nothing to do with you anymore. Right? Because you've paid yourself from the buy, you've paid yourself from the sell, and you are going to be good. And just by this trade, closing 7 lot size is like you closing 1 to 7 risks to reward already, even before you get here. This is like 1 to 8. So closing 7 lots is like closing 1 to 5. And this one to closing 1 to 5, you have already closed like 1 to 8 already, and you still have positions running. So that's a big flex for you. So now again, what do I have? I'll get it on this buy again because I know it is a valid order flow. Even though I know that this market wants to sell, I will still never ever neglect this beautiful bullish order flow. That is one thing I used to tell people. React and don't predict. If you predict, you'll be able to do this. But if you react, that is when you'll be able to do all this. So now, and people just feel like ping pong. Ping pong is crazy because you need to understand how to position your lot sizes and how to get out on lot sizes. Okay? So I opened another 10 lots right here. After I open this 10 lots, I have, so now this 10 lots right here will add to this. So that makes this guy what? Plus 10. Alpha.
Ṣé that milk, that big milk? A máa pò pẹ̀lú gbogbo náà ṣé inú ẹ̀ náà la a máa blend ẹ̀ mọ́ náà ni.
Tó bá ti pò tán, wàá dà sínú. Wàá blend gbogbo ẹ̀ papọ̀.
Máa blend gbogbo papọ̀.
Omi ò gbọdọ̀ gbóná jù ṣá. 3 lots. So that would be 3 lots plus 10 lots equals 13 lots. So we have this plus this one right here. Then we have 13 lot size. So we took the 13 lot size. Remember, we have 13 lot on the buy now, and we now have 3 lot on the sell. So the 13 lot, then, because we still have this, so the market bought. After buying, this is now when I see my own sell signal after getting here. So after the market get to this guy, I would also remember I have 13 lot size. So this is what I'm going to do. I'm likely to do. They have stopped out this one at break even. Remember. So we don't have anything on the sell side again. So I'll be opening a 10 lot size on this one. But before opening the 10 lot size, I have 13 lot size, which means I might, on this buy right here, I have 3 lot size here, I have 10 here. I will close, as for me, I'll close 8 lot size. So we'll now be minusing 80 minus 13 minus 8. Then you'll be having 5 lot. So I'll be having 5 lot on the buy, then I'll be having 10 lot on this new sell that I'm taking. So having all that, looking at this buy order flow now, there is no buy demand again. So knowing that fact that there is no buy demand, I open my 10 lots here, I will have my buy lots here. So once I see that this market start rejecting and I'm already at break even on this one, I can even close more position on my buy because there is no demand again on this buy. Every order flow is complete, and consecutive mitigation is always a creation of liquidity. You can see that this is now a trend line liquidity for me, which will give me a signal to even close more position on this. I can even close out of this 5, I can close another 3, remaining 2. Then I will leave my sell positions to keep running. So because I know that now the bullish intention has been complete, so now my sell can move aggressively. I can only take partials on my sells if I know that I have a trade zone in my demand. But looking at this price action, no simple trade zone, no simple liquidity, it is just mitigations. So I have nothing to do than to just wait for my markets to keep going over and over again. So I will have take this sell, then I will have take this sell. So that is just that about that. So it's beyond that, because it's something that you cannot just start doing in a day. So you have to watch this video over and over and over and over again and try to understand if you are comfortable with it. And your strategy must be intraday before you can say you want to be edging, because you can't be doing all this on your daily time frame analysis, because you have to be trading on 15 minutes, 5 minutes. You have to understand liquidity, you have to understand structure, you have to understand time before you can able to do this. But this is how I positions my lot minus my lot based on liquidity, structure, and price actions. So I want you guys to watch this over and over again. It is beyond this. It is a big topic itself. So that's just that about that, guys. So this is a very big topic, but I hope this little summary will help you. But before you can even do this, you have to have a very high level of confidence in your analysis before you can do this. This is the originator of ping pong, right? But there are some things that are also kind of being considered, which like time, structure, other factors. Retail concept, liquidity concept, every concept are being put in place when I want to apply this in real life. But with this and applying it to your strategy, this is my strategy. You can apply just the trade zone idea. Every buy, there will always be a trade, and every trade zone means this point can sell low. So rather than contemplating too much, just do what? Just close out some partials and take that sell that you think is going to hold. So if it's old, you are making money, but if it does not hold, you still have your buy running. So that's how it works. So that's that about that, guys. If you like, watch. If you like, don't watch. That's yours. And one thing about it is, all this my video that I've been dropping, one day you can just wake up and just see that you can't find those videos again. Okay? So I want you guys to keep that at the back of your mind. So thank you guys, and thanks for watching. How will I escape this thing though?